Hello, hello. Good to see you, everybody. Hi, I'm Rosalie from Panoptic. This is the Future of Derivatives podcast. We're here with another episode. Today's guest is Nikolai from Altitude, and we have Guillaume here from Panoptic as well, our CEO. So, welcome, and thank you, everybody, for watching and listening, and welcome, Nikolai.
Rosalie, thank you so much for the introduction. Yes, it's nice to be here. I appreciate the invite to be on your podcast. Looking forward to discussing some of the things that are going on in DeFi, about institutionalization, some big hedge funds coming into the space. Very excited.
Yeah, definitely. I think a lot of things have been kind of speeding up and changing drastically in the LP space, in the yield space, and also in the derivative space. Our last podcast as well with STS Digital seemed to have a really positive take on derivatives from the institutional side. So yeah, we're thrilled to have you and kind of talk about all those things. Just maybe give us a little bit of an introduction, how you kind of got started in DeFi, a little bit about Altitude, what you're working on, and yeah, just your background.
Great. Thank you. So yeah, when we got into DeFi with Altitude in 2022, early 2023, so we're actually quite new. Uh, and we decided to jump right into the more difficult part in MEV infrastructure. So we went through all the backend documentation of Flashbots, of the more recent incumbents of the MEV space. We've learned all about Jared from Subway and so forth. And yeah, over time, we've developed more tools that helped us analyze pending transactions. We have servers for all over the world that basically ingest the mempool. We have relationships with various uh, private mempool companies that, generally it comes from wallets and so forth. And yeah, and today we build all sorts of tools in DeFi. For example, we allocate capital towards LP positions on Uniswap, but we also allocate liquidity to lending protocols like Morph and Aave. Uh, we're developing basically uh, everything to do with DeFi, more focused on getting traditional finance and traditional hedge funds interested in the space, and that's kind of what attracted us to Panoptic and Guillaume, because a lot of that really resonates. So that's my a little bit about my background.
Nice. Yeah. Wonderful. I think definitely a lot of retail people, I think, are kind of still viewing LPing as more of a passive thing. I know if you really want to be good at LPing, it's quite active. You got to manage your range and everything, kind of like managing option positions as well, right? It can be quite active and you got to kind of stay on top of everything. So it's not as passive as people might think. I'm curious to get your thoughts on how you think professional managers think about LPing different from kind of what retail people think, and what separates these liquidity strategies from simply just depositing, or even maybe if you want to compare it to kind of lending on Morpho or Aave, as you mentioned.
Yeah, sure. So yeah, I guess when you're looking at LPing as a professional thing that you're doing, you're choosing a narrow range, which means that the price of your token is likely to leave the narrow range, which means you'll have to rebalance. And with that comes a certain set of responsibilities, like analyzing every day, or depending on how narrow, perhaps every minute, uh, your LP range. So if you're looking to do professional management of your LP position, you are going to find yourself writing a lot of tools that analyze blockchain. Perhaps even you go into the prop AMM side where you're analyzing even pending transactions, with the or what they call atomic AMM, pending transactions to try and get ahead of the market and rebalance your position using MEV infrastructure with arbitrage. So uh, you can basically go as deep as you want, yeah, and you'll find some very complex strategies if you're a professional.
Why do you choose a narrow range instead of a wide range?
Yeah, so I guess for retail people looking to improve their LP game, uh, a narrow range basically allows for your liquidity to be used in a very specific price range of underlying asset, and therefore this is a concentrated position which produces a higher yield. Now, the risk is that once the price of the asset leaves the narrow range, immediately you stop producing any kind of yield until the price of the asset comes back into the range. So that's where the idea of rebalancing comes out in.
Yeah. So basically, this is almost impossible to do with some sort of automation tool. This is not really something you can just do by sitting in front of your computer and manually kind of checking.
Well, it depends on the range, right? If you choose a medium narrow range that leaves where the price of the asset leaves once per day, that's manageable. You'll still have to manage the price of swaps and the price of your token. Uh, you'll have to swap at the right time and visit your computer. So generally speaking, we see most people try and write all sorts of scripts to analyze the price movements and rules. As you approach one of the boundaries, you check the price to swap. If the price to swap is manageable and the gas is low enough, then you make the action to swap. So you exit the position, swap. Uh, Sometimes if your position is quite large, if you're talking millions of dollars, you don't have enough deep liquidity in the system to actually make the swap. You have to go to OTC desks as an institutional OTC uh, on Binance, for example, and then get off-chain swaps to rebalance your position. So that's kind of like that. Those are some of the hurdles you face as you scale up.
Yeah,
And maybe I'm
definitely.
going to add that I don't know how large or how wide your positions are, but if you're pushing this to the limit and use a single tick or very, very narrow, you have to be block by block monitoring your position. But as you widen, like the price will take some time to diverge. And if you are plus or minus 50%, then maybe you can actually redo the same management techniques that Nikolai is doing. But at the retail level, you check once a day and maybe you manage once a week because you have kind of a wide range. And it is kind of that same tooling that you can do for narrow positions can be applied to larger and wider positions so that you don't, again, a lot of the talks about LPing is that it has to be professionalized. But if you are using a wider range, you can still be quite sophisticated in your management, but then do it at a much slower pace that, yes, doesn't require you to be in front of your computer 24/7.
Well, that's actually a great thing about the freedom that LPing gives you is that you can practice at a wider range and see if your tools actually work. And then you slowly narrow down the range as you are feeling more confident with the scripts and the tools that you've built off chain that manage your position. If you're testing a strategy that you're moving from by hand repositioning to a automated repositioning structure, that then you know that's also a good way to do it. Start wide and then narrow down over time.
When you're constructing like your whole LP portfolio, what kind of variables are you looking to optimize for first? Is it fees, volatility, risk adjusted returns, capital efficiency, maybe hedging or downside protection? What does that kind of look like and what's most important?
So altitude manages a bit of a larger position. So the biggest thing that is important to us is just the depth of liquidity. If there is no deep liquidity, all of the things you listed have a problem, right? The price of the asset, the friction to swap it from one asset to another, uh, you know, everything goes out of whack. So if the position of one LP position is say $1 million, $2 million, uh, we need to have at least that much available to swap either in the lending protocols or in Uniswap or other swap systems in order for that position to be safe enough to participate in. Otherwise, otherwise the barrier to reposition or to rebalance is so high, and the risk is so high that it doesn't justify uh, the position. So yeah, the depth of liquidity. That's my answer.
Got it. Yeah. And where are you currently kind of finding this? Is it difficult? Do you have to kind of go off chain a lot and optimize for this, or is it possible now?
So it's still a little bit tough. There was a period where we had very deep liquidity in LPing, it was like late 2025, where you could rebalance a $1 million position quite easily. Nowadays, it's a bit more difficult because generally we've seen DeFi TVLs drop about 50% of what they were late 2025. So that said, we have to go to OTC quite often. So we've built the relationships with the OTC desks, which means it's a slower process because generally there is no API OTC trading available yet on most platforms. They need manual clearing through some sort of a chat or an email. So even the larger positions have to often accept a wider LP range and a slower rebalancing rate. So I wouldn't say that's a big problem, because it's good practice for the future anyways. Because there's signs of institutional interest where we can potentially see an explosion of TVL, an explosion of deep liquidity in the system overall.
And I don't want to have you reveal any alpha, but is it mostly on like ETH, maybe Bitcoin? I feel are quite liquid, but it's the medium to long tail of assets. So is it mostly when you have stablecoin pairs or some exotic token that you're managing against ETH or USDC? Can you give a flavor a little bit of how maybe difficult might be to say I want to swap two assets? Even the OTC desk may have trouble sorting.
Generally, we've seen the best results on our stablecoin pairs, because they tend to have lower volatility. They tend to allow for a much narrower tick range. And if you're talking blue chip pairs, it's a bit more difficult without hedging. So the blue chip pairs definitely require hedging in order to manage the impermanent loss. That's a more advanced strategy than, for example, just choosing a narrow range on a stablecoin pair, and rebalancing it using an OTC desk once every couple days. That's, even on a larger scale, that's a simpler strategy to follow. So for that reason, because it is a little lower risk, we see most of the positions on stablecoin pairs.
Yeah, you mentioned impermanent loss as well, and kind of these risks that go into LPing, which can, depending on the price of the asset, pretty quickly. I mean, impermanent loss is pretty permanent sometimes, right? So, how do you think investors should think about LPing? Because I think right now there's lots of different strategies, right? There's yield strategies, volatility, harvesting strategies, kind of seeing LPing as more of a market making tool, more of an options selling tool, more of a derivatives tool. So, how do you guys think about it, and what would your advice be for kind of the future of institutions and investors to kind of shift their perspective, maybe to view it a bit differently?
Well, I like the three things you mentioned: derivatives tool, options selling tool, and market making tool. All those things are very relevant, especially market making, because we see the deeper the liquidity in an LP, the more stable the asset's price overall and lower volatility, which in turn attracts more liquidity into a narrower range. So overall, liquidity being at work in the market is a really great thing. Because it stabilizes asset prices, and it allows people to borrow. It allows people to swap. I like to always say the money under the mattress doesn't do the system any good. So LPing is one of the first examples of how we can actually use this great new technology, which is like internet money, but instead of holding it inside of a wallet, like similar to under the mattress, putting it to work. So yeah, it creates a lot of value to the system overall, I'd say.
My crypto is all under the mattress. But you did mention kind of low volatility. So in terms of harvesting volatility and kind of these more wide range delta neutral strategies that can accumulate the fees and potentially maybe with hedging and other strategies included kind of outweigh impermanent loss? Is that something you're thinking about as well, or mostly trying to kind of go in the other direction of more low volatility?
Well, I mean, I guess there's two questions here that you're asking: is volatility fee driver, and also is volatility something that scares LP participants away? But I would say that, you know, volatility is something that uh, is good when you have a structure for managing its risks. Uh, Specifically, I'm talking about hedging using options or perpetual options. So, I mean, in the past, what we've done is some OTC desks also offer off-chain options that can be rebalanced along with the position, like you said, to create a delta neutral position, which which makes a blue chip pair LP more similar to like a stablecoin pair. I mean, what we've seen is that it still has a little bit of overhead risk with just having that by hand management of the hedged position. So specifically the options off chain, because again, there's no API trading for that. You have to you have to reposition through some sort of a portal or through a chat, which can make it very difficult to maintain the delta neutral status of your LP position. So I guess that's where we can talk about partially hedged positions, uh, but it's a bit of a difficult subject when it comes to more like the OTC side.
Yeah, definitely. I think with Panoptic and kind of perpetual options, lots of things I think are going to kind of change a little bit on that front and how these strategies can be optimized and also just made automatically with vaults or kind of structured product type strategies or things like that. So I'm curious to kind of see what you are thinking in terms about using kind of vaults and these strategies. What are your most like your day-to-day goals when LPing? Are you kind of more trying to really capitalize and take larger profits, or is it mostly to make sure you're not really losing as much money? Because I think when you're just kind of trying to manage risk, it looks a lot different than when you're trying to really get high yields and take home those big profits.
Well, I think taking profits from an LP position is a bit of a misunderstanding of modern LP to date, uh, because the way we look at it is more as an R&D expense. So, and I can explain what this means. So, uh, you know, at some point in the future, we will have on-chain assets that have all the infrastructure, like the options, the futures, uh, and the underlying asset digitized, like the S&P 500 and the U.S. stocks. Uh, and at that point in time, it's the hedge funds and the companies that have experience in on-chain LPing and experience in managing their uh, smart contract positions using code snippets. Uh, those are the companies that will have the first movers advantage or the edge when the world finance finally moves on chain. But today, it's actually very unlikely that if you see like a 45% APY on a blue chip pair, that you can actually keep it after you pay all the costs of rebalancing, the costs of hedging. But I don't see that as a problem because, like I said, it's an R&D expense, which in the future, once real companies with revenues and profits and underlying asset yield come on chain, that's when the profits will actually start appearing.
And I really like this framing too, because the market that we've seen over the past 5 years is a R&D experience. It's a playground. We were trying to figure out new financial products, and it's not totally clear how to manage them, what to do with them. But yes, when we get to a point where you can trade stocks 24/7, you can actually trade futures, you can trade commodities, and the place to be trading when there's the event over the weekend is going to be on chain. Then you'll see a lot more of these pools be traded, and the demand will come from there. And that's also, again, as you said, the more prepared we are now to face this, the better we are when it's actually going to show. And again, we have tokenized equities, X stocks on there as well. And this is starting, and it's actually quite easy now to even trade these tokenized assets. But yes, once you have the bulk of the financial, and even Robinhood Chain is an example, but when you have the bulk of users, bulk of brokerage firms that now have a foot in the door for on-chain finance, then yes, they will use the same tools that we use now, which is AMMs, Uniswaps, Perps, and everything else.
And that's going to be incredible. So I guess I think the lesson people should take away is if you're coming into this hoping to make a quick buck today, or make a little bit of fast cash, this is definitely not the place for you to be. It's a very long-term commitment into how the future of finance will look, and the value will come from looking at it from a bird's eye view and understanding that it's not going to be, for example, easy passive income right now. It's going to be something that that only comes on a system-wide level as a benefit to the entire system, entire financial system, rather than individuals at some point in the future. And it's not necessarily today.
That was kind of my next question as well. Kind of what are common mistakes that newer LP managers are making when scaling? So maybe you already answered that, but maybe there's also something else we're missing.
Well, still, I mean, there's an important one. Common mistake is well, just because a person saw, for example, a 40% APR on an LP position for like a month, and they get excited, they start telling their friends, attracting capital, and they grow their position from being $1,000 to being $100,000. Suddenly, they're faced with a liquidity issue, where if they try to exit the position or rebalance the position or hedge the position, there's just not enough liquidity in the system to support a $100,000 position on their on their LP that used to generate 40%, but now perhaps it generates less because they've exhausted the demand for that pool anyways, because the pool only needed a couple $1,000s worth of liquidity to justify all the swapping volume. So I think that's that's a common mistake, is people overestimate the ceiling of an LP position, or the size of a liquidity pool in general, and how much how much fees it can generate with the existing swapping demand.
And what kind of instruments do you think are most effective for hedging this kind of LP exposure? I guess it becomes more and more complicated the more you scale, but when you're kind of working with a reasonable amount of liquidity.
Yeah, if it's a small position, I'd say obviously OTC desks do not work because you need to have like a Cayman Islands fund organized with licenses and everything. So, but for smaller position, everything decentralized is a great bet, and that's why we've been so excited about Panoptic in general. Is the combination of a vision of bringing traditional finance participants like hedge funds and investment banks on chain, using the instruments that they traditionally are used to using, but also opening it up in such a decentralized way where even smaller participants with $1,000, $5,000 can also try and learn the tools and so to say learn the ropes of managing an LP position. And that's what's so exciting, is the combination of having big players supply the liquidity and having small players learn the system. It really joins a world that used to be very separate. You didn't have much travel across the gap. Panoptic is kind of bridging that gap today, and that's what's really exciting.
And again, I would add that one of the problems, that if you're scaling and you want to hedge, then yes, you may have to use a multitude of different venues. You can hedge maybe on Hyperliquid. You do some borrowing and lending on lending protocols, and you have to kind of split your capital and have kind of collateral in all of these places so that you can still net everything out, but it's still in separate silos. And at least with Panoptic, we're trying to kind of offer the tools that have been used for, again, decades in the financial world, like prime brokerage, where you can net all your positions across all of your different exposures into a single collateral pool. So you don't have to kind of top up your Hyperliquid collateral because you're kind of going long in one side. So there is kind of a gain that happens when you have more capital coming in, but all this capital can be used within a single kind of single pool without having to split.
Yeah, that's the future. That's the dream for sure. How are kind of vaults, structured products, and other automation tools playing a role in your LP management? Do you use these at all? Or I guess since you're kind of creating your own MEV bots and things like that, do they not really apply to you? You're kind of building them yourself. How does the relationship between LP managers and potentially derivative protocols there change now or has influenced your LP strategy?
Well, in our case, yeah, we have our own smart contract team. We have our own analytics team internally, so we don't kind of use the pre-built vaults at Altitude. But I see the value in creating a strategy, putting it on a vault on chain, and making it accessible. It's I don't know too much about it to answer this specific question, but I can definitely see the value in it.
Got it. Okay. Yeah, definitely. And then what do you kind of think about the idea? The Panoptic is built on the idea that LPs are essentially short volatility. Do you kind of think about this framing yourself when you're trying to manage the volatility markets? Or is this kind of more separate to kind of applying these hedging strategies or the OTC side of LPing at scale?
Sure. Yeah. So short volatility, I guess you mean that as a LP manager, you do not want to have high volatility, so your price doesn't exit the active range too often. That makes complete sense. But I guess with the hedging tools, you can definitely imagine still being within range even during a high volatility environment. So, for example, you have your option chain on Panoptic, for example, that allows for you to keep your delta neutral position even in environment of high volatility. I'm not sure I fully understood your question in that sense, but that's all I can say.
I just kind of mean that, LPs are basically short convexity strategies and already selling options. And if you think about LPing from more of an options perspective, if that kind of changes your strategy.
Well, yeah, go ahead, Go.
No, I'm going to say like the when you're pilled in a way, Panoptic pilled, you start seeing that a lot of the tools that you need for LP management is kind of rooted in options world. And a lot of what I personally am using myself is, the volatility of the asset, the realized, which is what really happens, versus the implied, which is how much fees you get, is the clearest signal that, again, most people that are LPing should also look at. Because sometimes there is a lot of volatility, but it's a good time to double down in a way. And sometimes there is no volatility, so it's a good time to kind of scale back. And a lot of it is rooted in that kind of options management, and you have to know a bit more.
I understand now. Yeah. Well, it's a great point. I mean, Guillaume, you always say, anyways, that an LP position on Uniswap is mathematically equivalent to a short position, or a short put option. And if you're holding a short put option, you get the premium upfront, and that premium helps you basically determine the price of the option. Well, where does the price of the option come from? You look at Black-Scholes equation that uses the implied volatility to arrive at the option's price. You can essentially use the same formulas to arrive at a premium on a perpetual LP position based on the volatility of the underlying crypto asset or on-chain asset. So uh, that's how I would look at it. Is that if the if the implied volatility is underpriced on an LP position, you can expect to make a profit if you enter the position, and it remains the same. The issue is that an LP position doesn't pay you the premium upfront; it pays you the premium over time as long as you remain in the tick position. So you kind of have to assume that the implied volatility remains the same. Otherwise, you don't get the full value of your premium in the LP position. So it's a little bit different because of that differentiating factor. But anyways, there's definitely a lot of math that can be done by just analyzing the implied or realized volatility of any particular pool, and then comparing it to the amount of trading demand and the amount of yield that is generated by staying in a specific tick range. So I guess that's. I'm guessing that was the direction you're going in, but let me know.
No, exactly. Yeah, I think you've kind of nailed the piece as well too. When you say you personally or media LPs may be looking for options venues to hedge, and you have an LP position, and you may be buying an option, you try to neutralize the position, but it's paid up front, so you have to have the capital up front, and that can hurt your baseline. But also, it's really price dependent at that specific moment, and the yields will change day by day, block by block, but then the upfront payment is constant. So a lot of market makers love the upfront and one and done type of structure, and they just have to worry about the continuous hedging. And in a way, Panoptic, or at least Uniswap, is both sides are varying. You have the fees, which is constantly changing over time, and also you have the premium that you may pay that is now maybe constantly changing. So it is a bit different in a way. And then yes, the management does reflect that, and maybe you can be profitable for a long time, but then you're able to exit in a way that is not tied to you buying back or kind of finding exit liquidity for that option. So again, a lot of what we're seeing is that the time dependent yields has to be arbed and understood very well to match what the upfront payment is when you use an option. That makes the thing a bit more complicated as well.
Definitely. I think, yeah, it sounded kind of like, Nikolai, this was kind of one of your concerns, and maybe this is a reason why institutions are still kind of hesitant to come on chain and potentially use decentralized protocols such as Uniswap to LP, because it's uncertain, right? You don't know what the fees are going to look like and what will accumulate over time, if that's going to outweigh your potential and permanent loss. What are kind of other things that you think are kind of keeping institutions from participating, or have recently changed in getting more institutions to take a look at DeFi?
Well, I don't want to speculate here too much because I don't necessarily know what's going on in the minds of the institutions or the decision makers there. But my guess would be that the general newness of the instruments on chain is still kind of a problem. It's not necessarily a big problem, and then also just a lack of instruments. So, hedging using options on a specific real world asset like a stock of a company, that's something that would have to be really ironed out before I think a large hedge fund could LP. And also, general liquidity in the system. Like, can they enter and exit the position without suffering huge losses on on price impact. So that's a big one. When you have MEV bots arbitraging, $1 million deals and walking away with $100,000 in profits. That's scary to a big check trying to LP into anything at all. So and I guess the idea there becomes that the liquidity, the volatility, and the swapping demand, it all needs to grow gradually. It can't really flood the market too fast, because you'll end up with a situation where somebody suffers a lot on price impact when they try to make a single transaction, in the size of say $100 million, right? And we hear stories all the time. Somebody tries to buy $50 million worth of Aave, and then they get $50,000 because of price impact. Mevbot walks away with a $45 million profit. So things like this, I think, is what is preventing institutions joining right now. But that's all temporary, because the blockchain is very scalable, as long as everybody kind of scales at the same rate.
What, yeah, what kind of have you noticed since you started with Altitude? Have had change in DeFi made these strategies potentially they're more or less profitable and one scaling capital? And what are you kind of most excited about for the next 3 years?
Next 3 years, I think I'm most excited about having more opportunities for general stationary assets to become active. And there is a great article by Greenfield Capital here, where they talk about EOAs, which are externally owned wallets, uh, which talks about how a lot of people don't really participate in the market. They have their crypto under the mattress, so to say, not because they don't want it to participate, but because they don't know how to, or just like they perhaps have an idea, but the friction is high. Uh, and the wallet doesn't really act like a savings account in any way, where a savings account in a bank could potentially use the deposit to send into the system, give out loans to businesses to generate revenue, to do something productive. Uh, Crypto doesn't really do that yet. So I'm really excited to see those EOAs become active in uh, in lending, in swapping, in any market activity that produce a value for the system in general. That's number one. And then number two is obviously seeing more of those instruments that traditional institutions, like banks, hedge funds, asset managers, and private equity firms, they need in order to participate. You know, and that's on the Panoptic side. That's another thing that is super exciting.
Definitely. Yeah, we already went over time a little bit. So I think we're probably going to cut it here. I really appreciate your time, Nikolai. And thank you to everybody out there for listening. This has been a really insightful episode. If you guys both have any last comments or want to say anything else, please go now.
Yeah, I guess all I can say is that it's looking really exciting, how the future is developing overall. That we see news from Visa doing settlement on the chain. Uh, I think a lot of people misunderstand what that means. It doesn't mean you tap the card and blockchain transactions happen, but when you talk about settlement, uh, you tap the card. There are balances between banks that pile up, and then at the end of the day, they settle up, or they have a clearing period, right? So if that happens on chain, that's exciting. That's tens of millions of dollars in volume per day that happen on chain. The more of this we see, the more blockchain and smart contract technology starts to penetrate the bedrock of our finance world. And then the more it will start to come down into the rest of the things we see online. Maybe we see actual transactions. You pay for a coffee, but that can only happen if a banking institution is willing to facilitate that. It can't really happen at the POS terminal level. It needs to happen top down. So it's exciting to see companies starting to evolve and develop those technologies in like the very basic level of our finance infrastructure.
Awesome. Okay, wonderful. Well, thank you so much. Thank you as well, Guillaume. You have any last comments, or should I cue the music?
No, yeah, thanks, Nikolai. This was great. Again, the sentiment sometimes in the bear market means that people are lost. They don't know what to do. There's Robinhood chain that comes in. People say, "Hey, there we go. Robinhood is going to be the main layer." But I do think there is a lot of you mentioned as well, like scaling on the blockchain is quite tremendous. You can have 5 different L2s, and they don't compete with one another, but they all settle on the same chain. And now with kind of in Amsterdam, there's going to be updates that make more. I mean, the gas is going to be cheaper. More transactions going to happen on mainnet, and you may want to settle on a chain that is managed by Coinbase or Robinhood, or you want to settle by a chain that's managed by 10,000 different validators all around the world. So there is kind of a value from not just being on chain, but also on chain on the most secure place to be as well. So again, the tokenization settlement will happen on these chains, and this is kind of the bullish take that we can take. And yeah, with AMMs, with options, with everything else being available, it's going to be where again all of the activity is also going to migrate.
Yeah, that's right. And those who build in the bear market are the ones to win in the bull market.
Yeah, again, I saw a Twitter article. If you're a startup and you quit, you die. There's no quitting. You have to keep going. There is like a vision that you have to maintain, and price goes up or down. It doesn't matter. You have like this vision in front of you that you have to achieve, and this is kind of maybe the same thing as you. Even though as you said, even though the environment may not seem well, and you see a lot of what you do for an R&D expense, this is what's going to pay off in the long run.
Absolutely. I completely agree with that.
Awesome.
Rosalie, Guillaume, thank you.
Thank you very much. Awesome. And thank you to everybody who listens. Have a great day.